Hey everyone, welcome back to Corporate Decoder, the place where we unpack big company secrets. Today we're diving into HireQuest's latest report, and let's just say it's a mixed bag of results with some hidden challenges and opportunities. HireQuest's latest filing is essentially a check-in on their business performance for the most recent quarter. Think of it as a doctor's report for the company's financial health. Now let's get straight to the numbers. This is where we see the actual financial state of the company. Take a look at their current assets as of June 30, 2025. They stood at about $51.8 million. That's up from $49.2 million at the end of last year. This means they have more short-term assets like cash and money owed to them. Their accounts receivable, which is money customers owe them, is a massive $42.8 million. While it's slightly up from last year, it's important they collect this money efficiently. On the flip side, their current liabilities, the money they owe in the short term, are just over $23 million. This includes things like money owed to vendors and employees. Now, what really matters is the owner's stake in the company. Their total stockholders' equity is about $66 million. This is a healthy increase from $64.8 million at the end of last year, showing that the company's value to its owners is growing. Moving on to how the company makes and spends money. Their total revenue took a hit this quarter, coming in at about $7.6 million compared to $8.7 million last year. That's a roughly 12% drop. The big driver of this drop is their franchise royalties, which fell by about 11%. This tells us the businesses that operate under the HireQuest brand aren't bringing in as much money as they used to. When you look at it as a percentage of the total money the system as a whole is making, their revenue is about 6.1%, slightly up from 5.9% last year. This means while overall business is down, their own cut of that business is slightly larger. Now let's talk about expenses. Their selling, general, and administrative expenses went up significantly. They spent about $5.9 million this quarter compared to $5.3 million last year. A big chunk of that increase, about $929,000, is due to transaction expenses, which likely means costs associated with recent acquisitions or other corporate deals. All these factors led to a drop in their income from operations. It fell from $27 million last year to $1 million this year. That's a pretty substantial decrease. Ultimately, their net income, the profit left after all expenses and taxes, also decreased. They made about $1.1 million this quarter compared to $2 million last year. This is a nearly 50% drop, demonstrating a tougher operating environment. Now, the company also reports something called adjusted EBITDA. Think of this as a measure of profit before certain non-cash expenses and financing costs. Here, their adjusted EBITDA also saw a dip from $4 million to $3.3 million to $3.3 million to $3 million. While it's still positive, the trend is down. Looking at the year-over-year comparison for the same 3-month period tells a clear story. Revenue is down, and despite efforts to control costs, their profits have taken a significant hit this quarter. For the first half of the year, the picture is similar. Total revenue is down by about 11.6% from $17.1 million to $15.1 million. The decline in franchise royalties is particularly noticeable at their MRI, Northbound, and SearchPath brands, which saw a 25% drop in system-wide sales. This is a significant decline, indicating challenges in their executive and professional recruitment sector. Interestingly, their workers' compensation expense saw a big drop. It fell from over $500,000 last year to just $127,000 this year. This is a positive note suggesting better management of workplace injuries or changes in their insurance structure. Their income tax expense also dropped dramatically. Last year, they paid over $500,000 in taxes, but this year it's just $56,000. This is due to lower profits and also some tax credits they are utilizing, which the company mentions as a factor in their lower effective tax rate. Overall net income for the first 6 months fell from $3.7 million to $2.4 million. This is a substantial decline of about 35%. The number of offices also changed throughout the year. They ended last year with 425 offices, and by June 30, 2025, they had 414 offices. This means they closed more locations than they opened during the first half of this year. It's worth noting that stock-based compensation, which is not a cash expense, also decreased. This means fewer stock awards were granted or valued lower this period. Now, a critical point from the report is that they acknowledge a material weakness in their internal controls over financial reporting. This essentially means there were some significant issues in how they track and report their financial information. They are working on fixing this by hiring more staff and improving processes, but it's something to keep an eye on. The report also reiterates their risk factors, which include economic downturns, instability in the staffing industry, and issues with franchises performing poorly. These haven't changed significantly, but they are constant reminders of the challenges HireQuest faces. Looking at the overall picture, HireQuest is facing some headwinds. Their revenue and profits are down, and they've seen a decline in system-wide sales, especially in their executive search divisions. The increase in operating expenses due to acquisition-related costs is also a concern. However, the decrease in workers' compensation costs, the benefit from tax credits, and the continued growth in their smaller segments like HireQuest and TradeCorp offer some glimmers of hope. The material weakness in internal controls is a significant red flag that needs to be addressed. While they have a solid franchise model, they need to navigate the current economic climate and ensure operational efficiency. What's your take on these numbers and what they signal for HireQuest's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.